Ever wondered how investors make decisions in financial markets? It's a world filled with intrigue, where the ability to predict, to some extent, the rise and fall of stock prices can make all the difference. One of the key tools in this high-stakes game is technical analysis, a method of evaluating securities by analyzing statistics generated by market activity. This is where John J. Murphy's book, Technical Analysis of the Financial Markets, comes into play. It's a classic guide that has helped countless investors to navigate these turbulent waters. The book dives deep into the nuances of technical analysis, shedding light on the patterns, trends, and indicators that can guide investment decisions. Technical analysis is more than just charts and numbers. It's about understanding the psychological dynamics of the market, interpreting the story behind the data. As we delve into the book, we uncover the secrets of technical analysis. What are the fundamental principles of technical analysis? Now that's an intriguing question. Let's delve deep into the wisdom of John J. Murphy to understand the basic principles that form the bedrock of technical analysis. To start with, we have the principle of supply and demand. In the world of trading, this principle is a fundamental law. When demand for a security exceeds its supply, the price tends to rise. Conversely, when supply surpasses demand, prices are likely to fall. This is an essential concept that underpins all market dynamics. Next, we come to the concept of trends. In technical analysis, recognizing trends is vital. A trend, simply put, is the general direction in which a security or market is moving. It can be upward, downward, or sideways. The ability to identify these trends allows traders to make informed decisions about when to buy or sell. Now, let's turn our attention to chart construction. This principle is the canvas on which all other technical analysis tools are applied. It's about plotting price movements over time to create a visual representation of a security's performance. This can help investors spot patterns or trends that may be indicative of future price movements. But it's not all about lines and numbers. Technical analysis also acknowledges the influence of market psychology. Market movements often reflect the collective emotions of the market participants. Fear, greed, hope, and other emotions can drive price changes. Recognizing these psychological factors can provide valuable insights into market behavior. Finally, we have the assumption that history tends to repeat itself. This principle is rooted in the belief that market patterns and investor behavior repeat over time. By studying past market trends and patterns, technical analysts seek to predict future price movements. These fundamental principles form the foundation of technical analysis. They act as the compass guiding traders and investors through the complex labyrinth of financial markets. It's like having a roadmap, helping you navigate the ever-changing tides of the market. But remember, while these principles can provide valuable insights, they're not foolproof. Always approach trading with a clear plan and an understanding of the risks involved. How can investors visualize market trends? Let's delve into the fascinating world of charting. Charting, in the context of technical analysis, is like a map. It plots the journey of a particular asset's price over a specific period, enabling investors to identify patterns and trends. In the realm of technical analysis, there are three primary types of charts: line charts, bar charts, and candlestick charts. Each type provides a unique perspective on market trends and has its own merits. Firstly, line charts are the simplest form of charting. They connect the closing prices over a specified period, creating a single continuous line. This provides a clear overview of price movements, making it perfect for beginners or for a quick assessment of the market. Secondly, we have bar charts. These charts provide more detailed information than line charts. Each bar represents a specific period and shows the opening and closing prices as well as the highs and lows during that period. This gives investors a more comprehensive view of market performance. Finally, the candlestick charts. Originating from Japan over 3 centuries ago, these charts provide the same information as bar charts, but in a visually distinct way. They use a thick body to represent the range between opening and closing prices and thin lines, or wicks, to show the highs and lows. The body's color indicates whether the asset closed higher or lower than its opening price, making it easier to spot market trends. Now, why is charting significant? Charts provide a visual representation of market activity, enabling investors to identify patterns and trends that could indicate future price movements. They help traders make informed decisions about when to buy or sell an asset. Moreover, charts serve as the foundation for other technical analysis tools. Indicators and oscillators, which we'll discuss later, are often applied directly to charts, enhancing their predictive capabilities. In conclusion, charting is more than just a collection of lines, bars, and candlesticks. It's a crucial tool that aids investors in predicting market trends. Charting, a crucial tool, aids investors in predicting market trends. Remember, successful investing isn't just about numbers, it's also about understanding the stories that those numbers tell. How significant are trends in technical analysis? Well, let's dive right into it. Imagine you're on a boat, drifting in the ocean. The current, the wind, the waves, they all represent different forces at play. But it's the overall direction of the tide that determines where you'll end up. That's what trends are in the world of technical analysis. They are the tides that guide our investment boats. Trends are the general direction in which a security or market is moving. They can be upward, downward, or sideways, and their identification is fundamental to technical analysis. They give us a bird's eye view of the market, helping us understand where it's been and, more importantly, where it might be going. Now, how do we identify these trends? It sounds complicated, but it's really quite simple. We look for a series of higher highs and higher lows for an uptrend, and lower highs and lower lows for a downtrend. And if the price is moving sideways with no clear direction, we're in a sideways or horizontal trend. But why are trends so crucial in forecasting price movements? The answer lies in the old adage, the trend is your friend. By identifying the current trend, we can make informed predictions about future price movements. If the trend is upward, we can expect prices to continue rising, and if it's downward, we can anticipate further declines. This allows us to make strategic decisions, whether it's buying at a low point in an uptrend or selling before a potential downturn. However, it's important to remember that trends, like the ocean tides, can change. Market conditions are dynamic and influenced by a multitude of factors. That's why continuous monitoring and analysis are crucial to staying ahead of the game. In conclusion, trends are the heartbeat of technical analysis. They provide a roadmap, guiding us through the often tumultuous seas of the financial markets. Recognizing and understanding trends is key to successful technical analysis. So keep an eye on those tides, my friends, and may your investment journeys be prosperous. What role do indicators play in technical analysis? Now that's a question that deserves some attention. In the world of technical analysis, indicators are akin to the tools in an artisan's toolkit, each serving a unique purpose. They are mathematical calculations based on a security's price and volume. The result is used to predict future price changes and trends, assisting in decision-making. Let's start by talking about trend indicators, the most common type. Moving averages, for instance, smooth out price data to help traders better recognize the trend. By comparing the moving average to the current price, traders can decipher whether a stock's price is likely to rise or fall. It's like having a crystal ball, only with a touch of math. Then there are momentum indicators. These are a bit like your car's speedometer, showing the speed at which a security's price is moving in a certain direction. They help identify the strength or weakness of a trend as it progresses over time. Think of it as a gauge for the market's enthusiasm. Volume indicators, on the other hand, monitor the number of shares or contracts traded in a security or market during a given period. They're like the pulse of the market, providing insights into the intensity of trading activity and potential reversals in trends. Lastly, volatility indicators. These are your market weather forecasts, giving a sense of the magnitude of price movements. They help traders understand the rate and magnitude of price changes, providing valuable information for decision-making, especially in turbulent market conditions. So, you see, indicators are not just numbers and lines on a chart. They are insightful tools that can help you navigate the complex ocean of financial markets. They provide a systematic way to analyze the market's past behavior to predict future price movements. In essence, indicators are like the guiding lights in the dark, helping investors make informed decisions. They are your compass in the vast sea of investing, pointing you in the direction of potential profits and away from potential losses. Indeed, indicators are the guiding lights in the dark. helping investors make informed decisions. What is the final verdict on technical analysis, you may ask? Well, let's recap. John J. Murphy's book, Technical Analysis of the Financial Markets, is a comprehensive guide that unravels the intriguing world of technical analysis, underlining its fundamental principles. From the art of charting to the power of trends and the role of indicators, Murphy paints a vivid picture of how these tools can help us make sense of the financial market's complex dynamics. Technical analysis serves as a roadmap, providing insights into market trends and potential investment opportunities. It is not a crystal ball, but rather a compass, guiding investors through the volatile seas of financial markets. It empowers us to make informed decisions, minimizing risks and maximizing returns. So, the final verdict: technical analysis is an indispensable tool in today's financial landscape. Enlightened with the knowledge of technical analysis, you're now ready to navigate the volatile seas of financial markets. Subscribe to Wealthwise Insights for more informative videos.